Homeowners could soon be paying more for their housing loans. Mortgage rates here in Singapore are likely to increase following the U.S. Federal Reserve's biggest rate hike in over 2 decades. At least one bank says that more people are reconsidering their refinancing options. But analysts say that higher interest rates may not necessarily mean more households are over-leveraged. Geraldine Yap with more.
Singapore households can expect to feel the pinch from higher mortgage rates after the US Federal Reserve's half percentage point rate hike, the highest since 2000. Local bank DBS says while it received more customer inquiries about their loan options, it also advises its clients to set aside funds to buffer against interest rate hikes. But one analyst says rising interest rates may not lead to homeowners switching to fixed-rate home loans. That's because fixed loans have already factored in future rate hikes.
Today, the gap between a fixed interest rate and a floating interest rate is as large as 1.2 or 1.3%. People are still choosing to go for SORA peg risk because it gives them a very large buffer. You can have a floating interest rate priced at 1%, for example, versus a fixed interest rate priced at 2.25%, right? So people are taking the risk going for floating interest rates, enjoying that buffer.
And while floating rates are expected to go up, another analyst says the spike will be likely higher for loans pegged to the Singapore Interbank Offer Rate or SIBOR.
Is always based on what the banks forecast. So in this kind of rising interest rate environment, SIBOR will be the first to go up, whereas SORA will react according to what is happening actually in the market.
Both analysts agree households don't have to worry about overextending on their loans. That's because there are several measures to protect borrowers, such as the total debt servicing ratio and mortgage servicing ratio.
The banks also apply a stress test of 3.5% before determining your loan eligibility. So this also means that if interest rates goes up to 3.5%, that you would have the ability to service your loan, right, and not default on the mortgage loan.
But they add, if interest rates continue increasing going into the next year, households with high levels of debt might start to feel the heat.